Good day. I'm excited to be with you today. My name is Dr. C. Adam Calery, and I'm happy that you're joining me for this session. The title for this session is Techniques for Creating a 12-Month Business Budget or Forecast. When we think about forecasting, in this case, or budgeting, what we're actually asking ourselves is, can we predict the future, right? And when we look at a 12-month budget, we're trying to say, let's keep it realistic. Let's just keep it within a time frame that we can handle, which in this case is 12 months. But even then, looking at it in this 12-month period, it is still technically a forecast. So is there a method, is there a way that I can put together a budget that I can use for my business? And that's what we're going to talk about at this moment. In fact, a typical budget looks like an income statement, in this case for a business. If any of you out there have seen an income statement, it starts off with revenues, your operating expenses, and then you disclose whether or not you've made a profit or not. Well, when we're developing a budget for a business, we want to use that same format. We want to be able to forecast revenues for a 12-month period, and we also want to forecast the costs that are associated with building those revenues. And then ultimately, we're trying to see if we made a profit. For those of you who haven't had accounting before, what that means is that your revenues, in this case, which are at the top, are higher than your expenses. And so if revenues are greater than expenses, the business will generate a profit. That's what we want to show. When we are thinking about doing a budget, we want to make sure we're not being too optimistic, which means we're just saying it's going to work. You know, no matter what we do, it's always going to work. You do want to take a conservative posture. You want to actually think about the numbers that you're putting into the budget because it's actually going to reflect your business and your business decisions. So what we're going to talk about today is how do you sort of slow down your thinking so that you can consider what some of the factors or some of the forces that may be pushing against your business that you may have to consider. What are some of the opportunities that are emerging that you may want to go after, that you want to include in the budget, and then bring it all together so that you'll end up with numbers that we're going to say are reasonable. Ultimately, you want to know that a budget is not going to be precise. We're not stating that we're trying to predict the future. That's not possible. What we are trying to say is that I want to think about the possible scenarios that may exist out there. You know, what can happen in the economy in the next 12 months that could impact my business? What happens if some of my workers decide they don't want to work for me anymore because we're in this new post-COVID environment? How will I handle that? What adjustments will I have to make in the business? How will my cost adjust if I make certain decisions? So you're just trying to think, these scenarios may be possible. If these scenarios should occur, then what would my 12 months look like? So that's how I want you to think about this. So I want to share with you that there's an importance in seeing your financial statements, in this case, as important advisors. So if you've never looked at your financial statements at all in the past, I want you now to consider them, because in building this budget, I may have to look back in time. I may have to look at my history and see how the business performed at different times, and then use some of that information to apply it going forward. All right, so let's take a look at a couple of slides I have for you. So to begin our discussion about budgeting, there are going to be 4 areas that we're going to cover. 1, summarizing the principles of budgeting. 2nd, we're going to introduce the concept of what we call a cash budget. Then we're going to give you a live case example of using this cash budget template. And last but not least, we're going to put it all together. Next, we're going to talk about the 2 learning objectives for the day. 1, we want to explain why cash budgeting is an important tool for managing a business. And we want to apply these learnings by using the actual cash budgeting template. This cash budgeting template comes from the U.S. Small Business Administration. It's something that you can find out there on their site. And it's just a real handy, easy way to put together a budget. And by having a template, it makes it easier for you to put information in or populate it so that you can at least get started. So our first section, summarizing principles of budgeting. There is a purpose or a reason for budgeting. As an owner manager, one of your primary roles is to pull together the resources needed to implement the ideas, create the products, deliver the services to the customers, and to create strategies to establish a sustainable business. So let's take a moment and think about the impact of each one of those items. Your ideas come from the vision that you've created for your business. This vision has to be funded, and it is important for you to know how much it will be needed or how much it will cost to actually execute and sustain the ideal in the future. Today we hear the word passion a lot, but you cannot operate the business solely by passion. You do have to think about how much is it going to cost in terms of capital or dollars in order to actually execute the dream, to make the dream become a reality. Regarding of the good or service that you're selling, we will be thinking about how we're going to deliver it to the marketplace and actually be able to fund that operation. Our customers have specific wants and needs. And again, we must ask ourselves, how will we fund changes or modifications to the amenities or the features of the products that we're going to be selling to our customers? In order to meet their needs, we have to invest in our product concepts, in our service concepts. Sometimes we have to promote or we have to market what we're doing. That's going to cost us something. Lastly, your strategy. The strategy represents how I'm actually going to conduct business. That must also be funded. Am I going to lease a space? Because before I was an online business. Am I going to broaden my footprint? Not only am I going to sell in Illinois, but now I'm going to sell in Michigan, Wisconsin, Indiana. Will you sell solely online? Will I need to buy, purchase equipment, vehicles, and so on? With a healthy budget, with an accurate budget, I'll be in a better position to decide and understand how much money will be needed. And then I'll be able to know who I need to seek that funding from, either from a creditor or from an investor. Well, there are three key benefits of budgeting. One, budgets encourage managers to address current business needs and prepare for the future. Budgets promote coordination and communication between possible business partners and employees. Communication with employees is very important here, and I want to just skip over that. Employees eventually will ask you, how are we doing? What does our future look like? And you want to be able to confidently be able to answer that question and give them examples of what you're doing to support business success. With those answers, it helps to build loyalty and helps to maintain retention of your employees. So that information or the information you share with them is going to be important. Lastly, budgets provide a benchmark that can be used to motivate employees and help managers evaluate performance against planned goals. There's a lot there in this one bullet, so let's break it apart a little bit. So one, when we think about providing a benchmark, what we're actually saying here is that I want to provide a standard, something that I can compare what we're doing today to it. So in this case, we could say profitability. I want to earn $100 in profit next year. That's my standard. Now, when we get to the end of next year, did we earn $100 or did we only earn 75 or 50? Or did we exceed our goal and actually achieve 120, 150? The answer is going to be important. If we exceed it, everyone's going to applaud. Employees are going to be happy. You're going to be happy. If you fell short of that goal, then it's going to raise another question. Why? What happened? Why didn't we achieve that goal? So now I need to start planning or coming up with solutions to make sure I take care of any situations that prevented us from hitting our goal this year, to make sure it doesn't prohibit us from being successful next year. So that's what we mean by setting a benchmark, setting a standard that I will compare my performance to, my actual performance to, and then I'll be able to evaluate how well the business is doing. That budget that you create will become that standard. And when you actually run the business and you actually collect sales or gather sales and you start to look at your expenses, you'll be able to compare those revenues and those expenses to your actual budget at the end of the year. And you'll be able to set your future goals. Budgeting begins by using your accounting information. And with this accounting information, you'll have a clear understanding to draw conclusions about the financial health of your business. I keep repeating that because it's important to know. But let me share a fun fact with you. And this comes from a business analyst named Brex. This was written in 2022. Quote, because of its simplicity, cash basis accounting is a go-to method for small businesses with 10 or fewer employees. Cash basis or cash budgeting. What does that mean? It just means that I'm looking at my bank account and I'm looking at money coming into my bank account and I'm looking at money leaving my bank account, and I manage my business using that methodology. Money in, money out. As long as it's above zero, I'm feeling pretty good. And we typically find this for businesses who have less than 10 employees, your startup community and those who are starting to emerge as a small business. However, I want you to consider something. The majority of small businesses, 67%, use what we call accrual basis accounting to track and report their transactions. Accrual-based accounting. That is something that has been developed by accountants. It's a more conservative way of managing your finances. And if you look at the percentage, or you listen to the percentage, it said 67%. That's a large number. So the majority are not using cash basis accounting. So we're going to spend the next couple of slides and talk about the differences between these two methods, cash basis versus accrual basis, and try to understand why the community has chosen the path it has, which is accrual-based accounting. Cash accounting means we manage the business by monitoring the movement of monies into and out of the bank account, by reviewing our monthly bank statements. It is truly an easy technique, but is not recommended for the long term, especially if you are attempting to build a well-established company with a number of customers and a growing number of employees. Why is that? Because when you're just monitoring the bank account, you're just monitoring the flow of money in and out. What you're missing are obligations that you may have created during the month, maybe with a lease that you recently signed or a contract that you recently signed that can either generate more revenue for you or could result in higher costs. Because they haven't been realized yet, meaning the contract hasn't been executed yet, monitoring money moving through a bank account is not going to allow you to see the possible impact that these new contracts, these new obligations may have on the business. This fact could create some unexpected cash flow issues for you, meaning new checks you have to write that you didn't expect that quickly reduce that cash balance in your bank account to dangerous levels. Adopting the accrual system or the accrual basis is a more conservative system. Eventually, it equips the owner to better plan for fluctuations in their cash flow. Cash flow either because of higher expenses or cash flow improvements due to higher revenues, because it's helping you to look at your numbers, look at your business in a more conservative fashion. As long as your sales are less than $25 million per year, a business is free to use either method, cash basis or accrual basis. But what I'm arguing is that you may want to lean toward accrual much earlier in your management process and start to become comfortable with it and start to use it earlier on in your business operation. We now just had a conversation about cash basis versus accrual basis accounting. Now let's consider what's the difference between budgeting and forecasting. So when I'm thinking about budgeting, there's some assumptions behind this. One, we think of a budget as near term. The word near term is another phrase for short term. A short period 3 months to up to 1 year. It's similar to your household budget, so a little bit easier to do. My time horizon, I'm only looking out 12 months. I can sort of imagine, I can visualize what's happening in front of me. So it makes it a little bit easier for me to estimate my cost, estimate my potential revenue. It helps me to estimate current financial needs or possible income amounts that may be coming in from new sources of revenue, either coming from expanded sales or the sale of more goods. And I can monitor current profitability. I can start looking at it on a monthly basis, on a quarterly basis, as well as an annual basis. Let's take a look at forecasting. When we look at forecasting, we call it a multi-year estimate, typically 3 to 5 years. So we're looking much further into the future. And in my past conversations with business owners, this type of forecasting is much more difficult because it's difficult for many to look beyond 6 months, let alone 9 months, to now consider looking 24 months or 36 months out. And that's understandable. But unfortunately, or fortunately, you do need to do that. You do need to get to a point where you're willing to look beyond 12 months and really start to think about how you want to position your business for 24 to 36 months out. The good news is we do have a session on forecasting, and we'll talk about some of the tools and techniques that you can use to help you do a longer forecast. Next, forecasting helps you to estimate potential revenue and profitability amounts. So the forecast is similar to the budget. We're just looking out further in time. We can use this forecast to predict revenue and predict potential profitability. And I use the word potential. Doesn't mean it's going to be accurate. Doesn't mean an exact measure, but it is possible. Last but not least, it allows you to consider the possible financial impact of options you are considering for operating your business. Different approaches in order to sell a product, to entice your customers, or to build your customer base. We call this scenarios. So a scenario is simply, I'm going to think about a possible situation, and then I think about how that situation may impact my business. And now what I will do is estimate possible revenue, estimate possible expenses, and plug them into my template, and it'll give me a sense of what possible profitability or losses could be in the future if that scenario should happen. So again, scenario planning, we tend to use that technique, forecasting. We'll talk about that later in another session. So you have 2 different budgeting methods you can use: cash budgeting or accrual budgeting. Cash basis accounting or cash basis budgeting has some benefits. There's a shorter learning curve. I don't have to take as long to figure this out. Fewer items to record because I'm looking over a shorter period of time. I'm only looking over the next 12 months in front of me. I'm not trying to look out 36 months. It's easier to track expenses and revenue, again, because of the shorter time frame. And it's ideal for startups. Why is it ideal for startups? Typically, my business is small. It doesn't have a lot of bells and whistles, so I don't have to track that many things. So cash budgeting is easier for me because the number of items that I'm tracking are relatively low or small. However, when I look long-term, and this is long-term as a founder or a business owner of a startup, you will need to consider making that shift, moving to a method that may be a little bit more conservative. So that conservative method, being the accrual method, will still allow you to track your profits and loss. It still will allow you to estimate your tax obligations. It will still be a service to you with regards to providing you a guide to help you with strategic planning or coming up with the activities or your goals for the future. With both of these methods, whether cash or with accrual, you need to know that there are some assumptions that you need to make and stay consistent with. So as I mentioned, there's this issue of benchmarking. A benchmark, again, is a standard. It can be an assumption about how you think the world will look going forward. Those assumptions will help you to really focus and narrow your budget to something that's a little bit more realistic. It helps you to avoid what we like to call miscalculations or overestimation, overestimating your revenue, underestimating your cost. The method you choose will be something that you will communicate with your investors, communicate with your creditors, because it's important for them to know that you are being very practical and you're being very intentional in running your business by attempting to budget. That helps provide them with a sense of comfort that you're not just out here, letting it just flying by the seat of your pants, but you're actually putting thought behind the decisions that you're making moving forward by taking the time to do some reflection and to do some analysis of your financial results.